Good morning, good afternoon, or good evening, depending on where you're at and what time you're watching this OWA live presentation. Good to reach out and speak to all of you again here today. Today I wanted to talk a little bit about some CD alternatives. We get this question a lot from our clients and people that we visit with. What alternatives are there out in the marketplace for bank CDs? As we all know, interest rates are a bit low and have been for quite some time. Interest rates bottomed out, the lowest they've been over it's been about a 30-year decline. They started to inch up a little bit, and then the last several months the Fed has lowered the rate again, and so who knows what the future holds. So what alternatives do we have out there? One of our most popular alternatives is called a MYGA. It stands for multi-year guaranteed annuity. Now, we've talked in the past about what annuities are. They are products where we invest money. They have a growth phase and they have a distribution phase that you control when you're ready. Some people just use them strictly to grow and pass it on to beneficiaries. But this multi-year guaranteed annuity is a great alternative to bank accounts. You can set one of these up with as short a period as just 1 year. The most common that we see are in the 2 to 5 year range. As an example, one of the companies we use has a 2-year guaranteed rate per year of about 3%. That's pretty good compared to what you see at banks. To get a better rate at the bank, you're usually looking at about a 1 year to a 2 year or longer CD, certificate of deposit. And those rates we see nationally are averaging in about the 1 to 1.5 range. So this multi-year guaranteed annuity, 3%. Now those rates change. About 6 months ago that rate was 3.2. Currently it's at 3. Depends on the carrier, but I mean, again, just talk to us, we can tell you what's available. Now, if you're looking for maintaining full liquidity on bank alternative money, we want to introduce you to a website. Go direct to www.bankrate.com. All one word, bankrate.com. You click on the piggy bank on that landing page, and it will take you to the top savings accounts for FDIC insured banks in the country. It researches about 4,800 banks nationwide and lists who those banks are and what the rates are. As you go into that website, the first page you come to is going to have a listing of 4 or 5 banks that have paid a sponsorship to be listed pretty on that top page. Scroll down a little bit and you'll see right below those sponsored ads the banks and the rates that are the top rates in the country. These are FDIC insured. Very simple process to link that bank to your local bank, and then once you have them linked, you can transfer money up, transfer money back, no fees. Typically they have very little or no minimum. And again, FDIC insured, 100% liquid at all times. So why leave money sitting idle in the local bank when you can put it up into the online high yield savings banks and get about 2 to 2.25 interest rate. No strings attached. Just link it up and enjoy those savings. Move it up there to grow, move it down when you need to pay bills. Okay, idea number 1. Idea number 2, let me share with you on where markets are now at all-time highs. We keep hearing the S&P hit an all-time high and the Dow, and that's wonderful news. But we all know that what goes up must come down. Historically, the markets correct themselves about every 8 to 12 years. So where are we in that pattern? Well, we're due. What we're saying is be careful. We talk about in the market, there's a bull market, which we've enjoyed for the past 10 years or so. There are bear markets, which cause us to hibernate, if you will. And we've experienced those in 01 and 08, and who knows when the next one is. And then there's a market that I call a pig market. Don't be a pig, because pigs get slaughtered. So let's be very careful. Get those equity accounts, 401ks, TSPs, etc., even brokerage accounts I think it's time to, let's start getting those winnings off the table, reduce your equity exposure, move more into the fixed income, even cash positions. Earning another 10% or so in the next year or two is not going to change your financial life. Losing 30, 40, 50% or more because of bad market exposure, that will hurt. If we look at the 01 to current, from the volatility that's occurred over that time frame, it took folks from 01 after those severe losses until the year 2013 before they were back to even. We can't afford 10, 15 years to climb out of a hole. So I encourage you to look at your positions with the TSP, look at the G fund, the F fund, maybe the lifetime income, the L income fund, and on your 401ks or other brokerage accounts, 403bs, etc. Look at maybe a 70 to 80% position in fixed income, low risk bond fixed income positions, and maybe only 30 or less in equities. So those are some thoughts, some ideas to kind of fine tune and retool. Don't be a pig. And we look forward to talking with you on our future broadcasts. Don't forget, questions can be submitted. Click on the link below, and we're happy to respond. We appreciate all of you and look forward to continuing to work with you in our financial advisory roles. Take care.